Hello everyone, and welcome to this Forex session. Just before we start, could you just put into the chat box whether you can hear me okay, because I sound very faint to myself through my headset. I'm just going to lift up the increase the volume slightly. So if someone, oh, fantastic. Thank you so much, Raymond. Thank you. Thank you, thank you, thank you. Brilliant. Thank you very much. Anyway. Thank you for coming along today, for taking time out of your day. It's lovely to have you here with us this morning. Of course, there's me, Anna, and David, who's sitting behind me. But before we start and to have a quick look at what is going on in the Forex world and the markets generally, may I just draw your attention to the disclaimer that I know you can see on your screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. Right, I'm sure you all know, you've seen your calendars today, but just as a quick reminder, it is FOMC day. Just have a look at Forex Factory. Where are we? Here we are, Wednesday. Yeah, and we've actually got the retail sales before, and then we've got the Fed funds rate later on, and the press conference. And of course, tomorrow we do have the BOE for the British pound. Now, markets have been, they've been fantastic from a trading perspective. Not so clever perhaps for investors. And when I say the markets, I'm obviously talking about risk assets such as equities. But there's been a really interesting, if you like, narrative and a set of there's been almost like a perfect storm of fundamental releases, the inflation narrative that we have generally as going on in the background, that it's affecting all of us. And by the way, just as a little aside, I can't remember who quoted this, but it came up on my Twitter line, and it basically said we have what it's called commoner inflation. That is the inflation that affects you and I, to which the central banks pay absolutely no attention to. And as those of you who've been coming regularly will know, we've been highlighting that since last year. And then you've got haute couture inflation, which is the specialized inflation that the central banks pay attention to because it's based on different models and projections and yada yada yada. Yeah, well, perhaps if they paid a little bit more attention to commoner inflation, they wouldn't be in the state they are at the moment. But yes, this combination, basically, obviously, as you know, the markets have had a real swoon. They went down heavily on Friday, they went down heavily on Monday and yesterday, but they've kind of perked up a little. And of course, that's all been reflected in the currencies. We've seen here, this is the Dixie, we've seen the dollar take off once again. Even the yen, as we can see here, this is the 4-hour CSI, finally came off the bottom. Now the yen, those of you who have read my books, are part of our program, will know that the yen is both a risk on and a risk off currency, but it's not been behaving in how it's kind of should be behaving. And that's really to do with the fact that the BOJ of all the central banks has made no commitment to raising interest rates. They are going to carry on what they've been doing for the last, David, 20 years? Yeah. 20 years with more bond buying, QE, buying ETFs, because in their economy, they don't have the inflationary problem that seems to be besetting the rest of the all other economies. And what's happening is, because they have made this known that interest rate rises aren't on the agenda, we're back to interest rate differentials. We're back almost to the carry trade. So you've got pairs such as the Aussie yen, the New Zealand yen, because their respective central banks have said, they're going to put in place a fairly aggressive series of rate rises because of the numbers that are coming in, either from the CPI, the PPI, whatever metrics that they like to use. So that has explained also the chronic weakness in the Japanese yen. What happens is, with a very weak currency, is If you don't have inflation, you will then import it, because if you import, certainly if you have to import energy, which is what the Japanese have to do, and turning back to the British pound, if you have a weak currency, and all your imports are going to be more expensive. And if they are those imports that are rising in costs generally, such as energy and with food, then that's going to feed the inflation bonfire. Is going to make it burn even stronger. So, but to get back to this particular set of this scenario that we've had, and what kicked off the current, if you like, swoon in the markets, and it really goes back to the Friday's CPI for the United States, which came in. It was a pretty bad number. There was no indication that the inflation number is going down. It's very, very elevated. It's the highest it's been in 40 years. The Biden presidency is looking more and more like the Carter presidency, where you did have very, very high inflation, although you didn't actually have a crash as such. The markets, markets can still go up even if inflation is going up, but it's the rate at which the inflation goes up. And similarly, markets can still go higher if interest rates increase, but again, it's the rate that they increase. Now, the difference, what happened on Friday is you had the CPI, market got spooked, bond yields went through a very key level, which is 3% across the board. It was the 2%, it was the 2 years, the 2-year note, the 10-year. The 10-year is the benchmark for the market. If you look at that bond yield, that's watched very, very closely. So as soon as the bond yield goes up, then markets get very, very nervous. But what also happened, and this is something that we haven't mentioned for a while, and it's in the program, the Forex program, and it's something that, as I said, I haven't sort of referenced recently in recent webinars, and that is what happened at the CME with what's called, and I'll tell you what it's called the CME Fed Watch Tool. Now, this is you can read about how the methodology of how it's calculated. There's a video demo of it, but essentially what you're looking at is the market, the probability of what what the increase in the interest rate is likely to be. Obviously, this is for what the Fed are going to do, and it's based on probabilities. Now, the number you have to look at, market expectation until, as I said earlier this week, was that the markets were expecting the Fed to raise interest rates to a maximum of 150. What you'll notice here is a range. It's 125 to 150. And if you look back, if you look across this set of figures here, a week ago on the 8th of June, the markets, the probability that this is what they would raise interest rates by, they would keep to what the market assumed to be their agenda, was over 90%. Because of what's happened, because of the very bad number that came in with the CPI, and the PPI was not much better, although there were a couple of releases in there which weren't quite as bad. Suddenly, it's gone from 125 to 150. It's to 150, 175. It's a bit like being at the horse races, looking at the spread on the odds, basically. So suddenly, is the Fed going to be even more aggressive, i.e., even look at up to, putting the range for the interest rate between 150 and 175? So back on the 8th of June, it was only 8%. I mean, a month ago, it was 13%, and then it dropped. So, market was getting a little bit complacent. Equities were kind of, they were kind of trying to recover. The VIX wasn't very high. All those markets that we look at and we monitor to tell us what sentiment is like. Is there fear in the market? Is there complacency in the market? Everything was kind of, yeah, things are bad, but the Fed are not going to be too aggressive. Suddenly that has changed. That has gone to 96.5, and interestingly, 175 to 2 now that wasn't even on the horizon last week. And today it's a 3.5. So you can see that paying attention to this this data can give you a bit of a clue as to why the currencies are moving, particularly the US dollar. Now you could say, well, why haven't why haven't we been looking at this until now? And the reason is, as we've said, is fundamental releases, fundamental news, they have their own cycle. So until recently, inflation wasn't really on the horizon. The problem was no inflation. Now we have too much inflation. Something like the Fed Watch Tool is now, absolutely center stage, and it's well worth going to have a look at it if you trade the US dollar, if you trade the majors, particularly in the run-up to something like the FOMC, or even the minutes, because sometimes when the minutes are, things will be said in there that will lay the foundation for the next meeting. So from a technical analysis point of view, where we use our VPA, we still look at the price action, we look at the candles, we look at the support and resistance, we look at the volume. And when we look at the daily chart for the Dixie, what we saw yesterday and the day before, we can see here there has been a lot of strong buying in the US dollar. We can see here we've got a nice big up bar. We've actually got a tail to the bottom of that candle there, but VPA is also support and resistance, and when the price reaches a significant level, and on this case we've got volume resistance based on the volume point of control. These bands are produced, calculated from the volume point of control, which is this yellow line here. That acts as what we call volume resistance or support, which we have down here. When that is combined with price-based support and resistance, and here we've got the fourth pivot from the Camarilla, probably not quite as important as the third, but still that is a a resistance. And also you have to bear in mind, excuse me, with the price action that we've seen in the dollar, you also have to make an allowance for the fact that what the Fed Watch Tool has been saying may already be factored in, because there's another element to what's been happening with the market, is that the market's having a bit of a tantrum. The Fed has backstopped the market until now. And it may simply do so again, because having high inflation, the stock market crashing, the economy slowing down is really a perfect storm to not just a recession but possibly a depression as well. So you also have to make an allowance, saying when you see these strong moves before a major announcement, such as as we said, we've got the FOMC, and bear in mind, anything to do with inflation at the moment is really, really important. Employment at the moment, yeah, that's important, but it will become very important if wages also get out of control. There's all sorts of issues with companies not being able to find workers. We've had things like the Great Resignation. The pandemic has changed behavior to an extent that I don't think we'll really get a grip with, get a handle on for at least a few more years. So maybe that move, has already been baked in, as it were, which is why we're seeing this pullback, this correction today, and we'll see what happens when it's time for the Fed later on. And of course, it's all picked up on the CSI and also picked up on the matrix. Now, I've actually gone up to the 4 hour because that's obviously half a session. Each session is 8 hours, and we can see here, yesterday there was such strong buying, and this market is mean reverting. Things become overextended, overbought, oversold. At some point they will reverse. I appreciate with the yen, it's taken a long time. It's been, clamped to the bottom. If I open that up, you can see the extent. I mean, let's have a look on the day. I don't think they're quite at the bottom. No, that's nothing really. But back to the 4 hour, and I've written about it on my Facebook page. There is a Facebook page called Learn Forex Trading, but if you type my name, you will. I post practically every day on these sorts of topics. So on the VPA and the price action within the context of what is happening on the fundamental side, but also the broader market, because it has a direct impact of what we are seeing on our charts. So the ones that the two pairs that have sort of caught my eye, and from yesterday, then I thought, yeah, they probably are going to reverse, because the reversal actually started yesterday. First of all, there was cable, and if we look at the daily chart for cable, if we start with the daily chart here, this is what we have. This is, as I said, what we've had. This is Friday, Monday, Tuesday, and we've actually had, sorry? A really, really nice break away from the volume point of control. Breakaway trading is something that traders, it can be frustrating because you do get a lot of fake outs, and it looks like it's going to move and then it doesn't, and then just reverts back into the consolidation, which is around the volume point of control. But this one is a real classic because you've got really nice wide spreads. You've also got rising volume, and then the third candle, you think, oh, okay, but there's a wick to the bottom of that candle, so there's clearly buying coming in. And also remember what I said about, when it hits support, this is volume support from the volume point of control. So just based on that alone would tell us, yeah, there is an element of reversal coming in. And it was picked up by the CSI, by the matrix, and what was going on the faster timeframes, and also the Renka. Now that may not go very far, because as I said, this is just a reaction to what we've seen with regard to the US dollar. The markets, have they now, I don't know, what do the markets know? People say, okay, well, they panicked, if you like, because the Fed Watch Tool has said, oh my goodness, it's going to go to 150, 175. Oh, is it even going to 2? Oh my goodness. And now they've kind of taken a step back and they think, yeah, okay, that's fine. So that's from yesterday. You can see the tail here, and there's a lot of volume under there. So there's a lot of buying coming in there. So you as a trader, you think, okay, well, how am I going to take advantage of that? Most of us are on I certainly am on the faster time frame. David has a different approach, and he will go through his approach because he's been trading the US dollar consistently for the last week or so. David, yeah, the last both short and long. So I'll get him to explain what he's been doing. And so what we do is we simply, look at our charts. We see where we are. So let's pull up the 5-minute chart here. Let's have a look what we've got here. We've got really sort of, for me, this is 7 o'clock this morning. This is the move down, the tail end of the of that move on the British pound. We've actually got a volatility candle with a lot of volume underneath it, but a big wick to the bottom of the candle. So this is, if you like, this is when it says, we do start to have this reversal come through. Lots of volume. This is really very early this morning. This is 6 o'clock. This is even before Europe came on board. But it's the tail end of Asia, pushes up to the volume point. But this is the point that I'm most interested in. And at the London Open, I've got congestion. Okay, I've got to be a little bit patient. The London Open, I tend to let it go through. There's always some trap moves. You find it's only, this is what I mean by, it's going to be selling off, because the pound has been selling off very, very strongly. So you think, oh well, that's going to, but it doesn't go anywhere. It stops at this support here, which is this volume support, back to the volume point of control, and in fact we then get the break higher from the VPOC. But to see that actually, I don't have the volume point of control on the on my Renko. What I actually have is I just have the Camarilla levels. I look at the trend dots. I see where the price action is in terms of the Camarilla pivots. I've got the trend dots. I've got the trend monitor, and basically combined with the time charts, when I think it's we're good to go. We've got a trend going. We've got a consistency of trend dot color and trend monitor color matching. Then that's my entry, combined with what I actually see on the time chart. Now this has gone to the R3. It has gone through it. What happens very, very often at these important pivot points, it will go through and then it will come back and test and go through and come back and test and come back and test. And the key to whether that will actually reverse or not, it sits within both the trend dot, but more within the trend monitor. We have had a dip into we have had a change of color, not a bright change of color, but this dark red, and if that goes back into blue, and if that holds like that, there is no reason why that cannot continue. And if we look at what the time chart is doing as well, we can see here, this is where at the R3 we've got this resistance here. It's got to get through this point here, which is 120.93, and we look at, this is the 4-hour chart for the matrix and let's put the pound up here, so where that is, for the pound and the CSI. But if we take that right down to, say, the 5-minute, where are we? Well, it looks like the pound wants to turn up. Really have to keep an eye on the dollar. Is the dollar, if we're going to carry on with strong selling of the dollar, and we just want this divergence to carry on. We need cable to go through. It's tested it once, twice. It's coming up to it again. The Renko is telling us stay in. Yes, we've had this, this change of color, but it's simply found support at the R3 pivot. This is the R3 pivot. The next question is, well, where is it going? If it does get through, where's it going? And this is where you look at your support and resistance levels again. We've got the 4th pivot on this time frame. The way these pivots work are all the time frames below, but not including the hour, they're refreshed every day. Between the hour and the daily, it's once a week. It's actually going to an R4, and there's the volume point of control out there. Is it going to, do we have enough time before the FOMC, if you like, to get from here to here? Yeah, possibly. It depends on what's happening in the rest of the market. If the indices hold up, I think they've reversed slightly this morning as well. Yields have kind of come off a little bit. Yeah, that's why not? But this is, this is a correction. Is the primary trend lower from the volume point of control going to carry on lower? That is really in the hands of what the Fed do this evening, and of course, because it's the British pound, what happens with the BOE tomorrow. And the other pair, very, very similar price action, is the Aussie dollar. We go there as well. Very similar. We've had, again, 1, 2, 3. In fact, this goes back to Thursday. We had the break from the volume point of control, a really nice trend lower. Then we had yesterday, this pullback, got to, again, got to the bottom of this. Actually coincided with the S6, also coincided with this lovely 2-bar reversal here, going back, which was the springboard for this move up here. And if we put those 2 candles together and you put that two lots of volume together, you've actually got a hammer. So 2 candle patterns for reversals are absolutely brilliant. They really work well in the Forex market. Now, if this carries on, what are we going to get here? Well, we haven't really got a bullish engulfing. We need the candle to be here, but there's a lot of buying under that wick, and that is supported by the volume here. So from a longer term, if you were short the Aussie dollar, is this a major reversal? Difficult to say, because as I said, we've got the Fed this afternoon. If you're on the shorter time frames, you simply take advantage of what you see on the chart. So the CSI, what's this one? This is the hourly. No. Yeah, that's what's happening on the 5-minute. We can see the Aussie is kind of flattening off a little bit. The dollar is is that going to reverse? Who knows? Maybe most of the move is finished for the time being. We've got, it'll pick up just before New York. We have to wait and see. And of course, as we move closer towards the FOMC, then you'll find the markets will calm and quieten down anyway. And what we're seeing on the CSI is reflected on the time chart, certainly the 5-minute and the Renko, because we're reaching a key support and resistance level. So VPA is price action and volume, but support, you've got to have, you've got to be able to mark on your charts these important levels of support and resistance. Doesn't matter how you do it, whether you use Fibonacci, we use, as I said, we use volume. We're, as part of our new program, our stock trading and investing program, we're developing more volume indicators to help us, give some structure and meaning to the chart. So yeah, what you see, the support and resistance, they will tell you, yeah, I'm going to get a pause there, I'm going to get a stall, I'm just going to have to be patient, I might get some congestion. And really, that's what you want as a trader. You don't want to be in a trade and just not have absolutely no idea what's going to happen, because the stress levels are just too high. It is, it's still based on probabilities. The probability is it's reached this point, it is at least going to pause. And for it to go through, you just look at volume. The beauty about Renko is because because we have the trend monitor and the trend dot, it helps, it keeps you in all the time. This doesn't change, that doesn't change, it can stay there as long as it doesn't change. You can you can take a step back and think, yeah, okay, I'll see what happens. Now what's interesting, you go up to the hour, using multiple time frames, you're actually at the volume point of control. So maybe this pause is going to be stronger because the volume point of control is also a really important support and resistance level. And it's a congestion point, as we can see here. Right, we'll keep an eye on that one and see what happens.
There we go. Hopefully you can see my screen. Hi everyone. Just looking around the nanas. Yeah, and hopefully you can hear me okay as well. Where to start? Well, can you hear me? Anna's just checking. Hopefully you can. Yeah, good. I will speak a bit louder. I'll even turn up the volume a little bit. There we go. Oops, gone down a bit. Now it's gone completely. Hold on a minute. Is that any better or not? Okay, there we go. Where to start? Well, for those of you who come along regularly to these, you'll know that we often talk about big money days. And I have to say, the last couple of weeks at least have been absolutely fantastic. If you've been trading these markets, you should have been making a ton of money. And this is really what it's about, because as I've said many times before, and Anna's said many times before, if you talk to pit traders of old, what they will tell you is that in a year, they will have several days when they make a huge amount of money, and the rest of the year, it's really, some days are up, some days are down, and it kind of evens out. But it's when the market is really moving that you have to pile in and make some big money. And that's what's been going on in the last couple of weeks. And to be honest, it doesn't really matter where you're looking, whether you're looking in Forex, whether you're looking in equities, whether you're looking in indices, futures, whether you're looking at cryptocurrencies. They have all been moving very, very strongly. And I have to say, the trading has been pretty straightforward. It's not complicated. It's really very straightforward. You just got to decide in your time zone, time horizon, where you're going to get in, how long am I going to hold these positions for? Am I holding intraday? Am I looking for longer term, etc., etc. If you're in the Forex program, I've been posting this up the last few days. This is the tiny little FXCM account, and this is mirrored across all our other accounts, because I can assure you what we tend to do here, we tend to do elsewhere as well. It wouldn't make sense otherwise. In the last 6 or 7 days, I think this has taken over $200, which I think is over 2,000 pips approximately. So we've gone from about $1,800 to over 2,000 now. And bear in mind, this is purely trading single micro lots in a basket. That's it. It is not complicated. It's not rocket science. It's very straightforward. You're spreading the risk. You're spreading yes, you are focusing on one currency, but nevertheless, you're spreading it across a basket of currencies. And if some don't perform, like the dollar CAD didn't perform particularly well in that basket, but others did very strongly, then it's great. That's where we are at the moment. We're at 2,000. I'm trying to get this, basically last year almost doubled it, and I'm trying to do the same again this year. Just really to show you that even if you have a very, very small account with a limited amount of trading capital, you can still make money. I know it's not a huge amount of money, but if you look at it, it's certainly not livable expenses, but if you look at it in percentage returns terms, it's massive. It's absolutely massive. Doubling an account in a year. I mean, that's what you've got to do. And all this is doing, and I know in the program, the one thing that we bang on about is, if you're new to Forex, by all means start with a demo account, but a demo account is going to teach you absolutely zilch. It will teach you how to use the platform. Once you know how to use the platform, get a live account, put a few $100s in, and start trading single micro lots and start to get familiar with just the whole business, the whole emotional response to making and losing money, because that's all it's about. We get a lot of questions in the forum about, well, where did you get in? Why did you make the decision? Blah, 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 blah. It's just looking at the charts. I mean, if you look at this is, sorry, that's on indices. I'll come back to that in a moment because that's been absolutely sensational as well. Just go to the currency pairs multiple time frames. Okay, I'll just pull up cable for a minute. Just move that out of the way, get the chat box out of the way. There we go. This is cable on the daily. I know Anna showed you this already, but this is on Ninja. And all you are looking at, even if you're an intraday trader, this will give you perspective. But if you're a longer term trader, it will give you the ins and outs of where to get in, whether it's time to get out, etc., etc., etc. I closed out that last night. I think it was something like $73, $74 because I'd been in there for a couple of days. It was starting to look a little bit like a reversal, as Anna said, on the dollar. So the dollar buying, the very strong dollar buying we've seen looked as though it was going to pause and perhaps reverse ahead of FOMC today. So we closed it out. As I say, it was $73, $74, 740 pips or whatever it was. And now we're sitting here. Am I going to get back in? Probably yes. I'm going to wait for the FOMC, and that's what you have to decide. Someone put a post up in the forum action and said, "Oh, well, they've closed out theirs ahead of FOMC." Fine, so did we. That's the decision you make. Now, other traders who are maybe holding this for much longer time frames will go through the FOMC and say, fine, okay, a bit of volatility, I don't mind, I'm holding this for weeks or months. That's entirely up to them, and it's a personal decision. It's not something you can teach because you have to make that decision yourself. We took the decision to close out, wait for the FOMC. Depending on what happens tonight, then we'll make another judgment call. And if it looks as though there's going to be yet more dollar buying, which I suspect there will be, then we'll jump back in. Probably not tonight, probably tomorrow once the markets have settled a bit and London opens, all the rest of it, and it filters through there. But if you look at this on the daily basis, I mean, this was a classic entry point up here. We had the VPOC up here. You know, you've got a very strong platform of support here. Once that gets breached, yes, we had a volatility indicator, but once we're off there, you know, down we go. You've got this absolute ton of price resistance overhead, which is going to protect you anyway. So you're going to slap your stop losses in above here. So in terms of any retracement, you've got massive, massive natural protection from the chart itself. You then go on down here, you know, we had some more selling coming in here. This was, you know, nice thing. Then you get down to the bottom here and you start to see the reversal coming in. So you think, okay, fine, well, you know, let's close out and see what happens. You start to see rallies like this, but it's on falling volume. And you think, well, this doesn't look particularly strong, but we'll see what happens anyway. And then you get this rally here, and this is where we started to really flag up because two reasons. First of all, you're coming back up to a level which has seen a reversal before. So you're up to this level here at 126.50 odd approximately. But in addition to that, you're seeing two other things. You're seeing very weak candles. These candles are narrow spreads. They're not strong. They're just indicative of a market that is very nervous, is not going to particularly take off. And in addition to that, it's coupled with the fact that the volume is falling away. So what is that telling you? Time to get back in, go short again. Yeah, okay, we had to sit through a bit of congestion, but boy, oh boy, then we started making a ton of money in here. So, you know, that's what it's all about. It is not complicated. You don't have to be sophisticated in what you do. You just have to understand VPA. And as Anna said, understand support and resistance levels, look at the VPOC, tie that according to the timeframes you're interested in, and then you make decisions accordingly. And if you look at the trend monitor down here, the trend monitor has yet to transition. This is going back to end of February, early March here. The trend monitor has not yet to transition into a fully bullish mode. It came out here a little bit. It started to transition here a little bit here, but now we're back into solid red again. And of course, you'll be looking at the dollar index chart as well, in addition to all of that. So that was cable, but it's pretty much, you know, the same on all the other charts as well. As I say, when you're trading a basket, you know, you're not going to win them all. I think from memory, I think the dollar CAD was a little bit of a laggard, and the one that I stay out of is the dollar yen. I never ever put a dollar yen into a dollar basket. Why? Because it doesn't move in the same way that all the other majors do, and that's all explained in the program. I'm sure we've covered that if you've read the program or you're in the program as a student. And if you go over onto the indices, and if you understand relational analysis and everything else, then, you know, it all just makes sense and everything backs everything else up. You know, this is the YM. Tough times for investors. You know, got to know what you're doing in the bond market. And can I also say, if you're an investor, and certainly from a UK investor, you've got to be aware of the exchange rate risk if you're investing in US markets. We are deeply conscious of it all the time. You have to be. This is on the YM. Similar sort of analysis, if you will. We had this rally. You know, we've had this a lot of this weakness coming in, and then you get this rally. You get four days of up candles. But you've got wide spreads here and you've got falling volume. The falling volume is over the 4 days and the spreads are rising, but they're actually rising on less volume. What does that tell you? It tells you it is weak. It's not very strong. Into the volume point of control, and then off we go down the races again, and we come down to the back of the bottom of the VPOC here. And obviously we're waiting for the FOMC tonight. Pretty much the same across all three. Not quite so dramatic, if you will, on the ES, but certainly on the NQ. So that's where we are. It's in terms of the broad economic picture, the Fed has completely screwed up. All central banks have screwed up. As Anna said, last year, what were they desperate for? Inflation. That's all they wanted, inflation, 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 and they wanted to get it to their 2% target. You know, that's always their goal. 2%. That's their ceiling. That's where they want to see it sit. And of course, what's happened is we've now got inflation, which is absolutely roaring. The irony, of course, is that this inflation is not being driven through economic reasons. It's being driven for a whole bunch of other reasons, and that is going to give the central banks a massive problem, because what they are going to do is they're going to raise interest rates to tackle inflation. But in tackling inflation in that way, with that very blunt instrument, they are going to cause either an economic crash, or at the very least, we are going to go into recession, possibly into depression, and in addition to that, possibly stagflation as well, whereby, in other words, you've got an economy that's stagnant, but you've got inflation that's rising, and that's the biggest danger of all. And that's where we are. They are reducing their balance sheet. They are trying to control it with interest rates, and it's just a complete and utter mess. They are way, way behind the 8 ball, and if they're going to control it purely with interest rates, you're going to see interest rates skyrocketing to get this under control. But as I say, this is not. We are in a phase of the economy which is perhaps something we've never seen before, because this is not natural inflation driven through an economy that is overheating. In other words, a hot economy where we are seeing inflation driven through economic reasons. It is not. It's being driven for all the other reasons that we're well aware of. And the central banks only have 1 or 2 mechanisms to actually control this, and they are absolutely in panic mode right now, and it is absolutely chaotic. And this is going to last for some considerable time. So do not expect this to be a one-hit wonder. This is going to drag on for some time until they get inflation under control, God help them. And that is going to be catastrophic in terms of economics, in terms of jobs, and in terms of everything else. Only our opinion, but that's what we see. Let me just pull this over, pop this up. Just want to show you this because it's this is the heat map for TradingView, and the reason we're having a lot of customers who are loving using this because it's so different to the heat map on the other platforms. And the reason it's so different is because you can actually set the time frames here to whatever you choose. So if you're a scalping trader, you could have this at 1 minute, 2 minute, 3 minute, 4 minute, 5 minute. If you're a longer term swing trader, you can set it to what I've got here. You can set it to any setting you like. You literally just click on it, go into settings, and here are all the time frames down here. You can also change the look back. So if you want to look back over a slow period, you can do that as well. I wish we could have this on the other platforms, but we can't. It is only on TradingView because TradingView is the only script that allows us to do this. And of course, what you can also do with this is you can have multiples of this. So not only do you can have 1 as I've got here, but you can have 2, 3, 4, as many as you wish. So I just wanted to highlight it. It's just getting a lot of feedback on it. It's just really, really good at the moment, really exciting. It's a lovely indicator to have to give you that flexibility. This is just the 4 currency indices. I've got the dollar here, top left. This is on 5 minute, the yen here going sideways at the moment. Sorry, I beg your pardon. This is the pound at the top, beg your pardon. This is the dollar at the bottom, selling off on the dollar that we've seen since 6 o'clock this morning, our time. This is over onto euro, a bit sluggish, and the yen, which is moving sideways. Just 1 or 2 other things to highlight here. This is on Bitcoin. As I said, Bitcoin, and in fact, all the cryptocurrencies are really, really having a torrid time. Bitcoin is down to 20 and a half now, 20,500 odd. It's really, really come off big time from, I think it was 67,000, something like that. Yes, there are intraday opportunities, of course there are, and we've got the currency strength, the cryptocurrency strength indicator as well, which really, really helps. But in terms of applying volume price analysis, exactly the same. All the other indicators, you can see we've got a bit of volatility triggers come in. And remember, the volatility trigger comes in, you don't have to wait for the candle to close. It's a beautiful indicator because it gives you that heads up before you actually need to make or before you have to wait for the candle to close. So if you're on a 1 minute, okay, it's not a big deal. But if you're on a 5 minute or a 15 minute or a 30 minute and you get one of these, boy, oh boy, it's powerful because you haven't got to wait. As soon as the metric of price action moving outside of the average true range is met, it will trigger the indicator, and that's it. And as I always say, if I'm in profit and I've got one of these, I close out because I don't want to sit through congestion. Certainly don't want to sit through a reversal. It's as simple as that. On the CCSI, this is the cryptocurrency strength indicator. What it is basically setting everything against Tether, which is essentially dollar, if you like. It's USDT. So this is basically the dollar. So we're looking at the basket of cryptocurrencies, all of these here. And in the cryptocurrency world, it's very different to the currency world, where cryptocurrencies will tend to move en masse. It's very, very unusual to find one cryptocurrency moving counter to all the others. They do for a few minutes maybe, but never, never long term. And in a way, it's actually great, as you can see here. And if you're trading one of these, then it gives you the comfort of knowing that, you know, we're all moving in the same direction. So if I'm trading Bitcoin, you know, Ethereum's moving there, Litecoin's moving there, et cetera, et cetera. And, you know, again, you use it in exactly the same way as you do with the currency strength indicator. What we're looking for is exactly what we have here, you know, a strong move to the upside, counterbalanced with a strong move to the downside, or vice versa. As I say, in this case, what you will find is you'll find all the cryptocurrencies will tend to move together en masse. Just move that out of the way. Just to show you one or two other things on Ninja. We're doing a lot of work on Ninja at the moment. Where are we? Let's go to Market Analyzer for a moment. This is Market Analyzer. If you have the full NinjaTrader package, then you will receive all these upgrades free of charge. This is one, this is Market Analyzer. So we've actually incorporated many, or as many of the indicators as we can. You can see this is on, I've got stocks up here, so there's not a lot going on at the moment. You've got the dynamic volatility, you've got Camarilla, you've got the VPOC, you've got accumulation distribution, you've got trend monitor, you could have more on here. So basically, we have incorporated that into Market Analyzer. So as I say, if you have the full package, you will get all of these free of charge. In addition to that, we are also working on, as Anna said, some new volume indicators. Just go back onto the currency pairs again. There we go. We're also working on some new volume-based indicators, which will be really specific to stocks, but you will be able to use them obviously on other markets as well. Things like the volume-weighted VWAP. We're also doing several other based on strength, and really looking at sentiment as well to help in terms of identifying stocks and opportunities on stocks for investment, and also from an intraday trading perspective as well. So as I say, if you have the full package on NinjaTrader, then you'll get all those indicators and the Market Analyzer stuff free as well. Let's just have a look at the currency matrix multiples. Just isolate out the dollar here. Let's see what's going on. There we go. Let's take the dollar out. Dollar out, dollar out. It's a little bit of sideways at the moment. It's no great surprise. And what the matrix does is it just gives you that perspective on sentiment. You know, is the currency pair that I'm trading moving in the same direction? If I'm buying dollar, is the market buying dollar across the matrix? If I'm selling dollar, is the market selling dollar across the matrix? It's as simple as that, and that's what it does. And that's one way of doing it. And the other way we do it also, you can actually do it in terms of chart based, because I've got if I go to the currency majors matrix, for example, this is where I've got the equivalent, if you like, but I look at it in terms of a chart perspective. So you've got cable, you've got dollar CAD, you've got Aussie dollar over here, Euro dollar, dollar Swiss, and New Zealand dollar, dollar yens are on here. So it really just gives you a perspective. So even if you're not using the matrix, you can use the actual charts themselves to see what is going on. And obviously you've got volume on here as well, so you get a perspective. And the other nice aspect of this is, for example, if you're trading something like Euro dollar and you want to see what the inverse is doing, then you get an inverse perspective in terms of volume also. So you'll see volume on the one particular chart, and that is mirrored the inverse of it on the opposite side of the trade, if you like, so where you're seeing buying dollar in dollar Swiss and you're seeing buying dollar in Euro dollar. So Euro dollar is going down and dollar Swiss is going up. It gives you a really nice mirrored inverted perspective on volume, and of course that's also reflected in terms of trend monitor and all the other indicators as well. And it also gives you perspective. For example, here where you've got the dollar Swiss coming up to the volume point of control. So if you were trading Euro dollar, then is this something you want to see? We've got the price action coming up to the VPOC on a 5-minute time frame, so we're expecting to see maybe some congestion there, so maybe not strong dollar. buying continuing in terms of dollar Swiss. That doesn't mean it's not going to continue everywhere else, but it's just another piece of the jigsaw puzzle, if you will, that just helps to frame everything. You know, over onto the CSI here, I've got this on 5 minute. We've got New Zealand and Aussie getting up into very much into overbought, Euro down here. And we've got the Swiss franc here. So if we were looking at a Euro Swiss chart, this would be going absolutely nowhere because the two currencies are following one another around literally one after the other. Equally, if we looked at a New Zealand Aussie chart, that's not going anywhere in this time frame because the two currencies there are also following one another around. So constantly what we're looking for is divergence, divergence, divergence. If we go over to the currency strength multiples, you know, that's what we're looking for. We're looking for divergence. We're looking for one strongly rising New Zealand dollar, the New Zealand dollar, for example, Euro falling strongly. So on a 1 minute time horizon, you see a very strong trend in that at the moment. That's also mirrored on 5 minutes. You've got the two here, New Zealand and the Aussie. You've got these two falling, and it's just getting up here much more slowly here, but they're still falling here, and they're still falling here quite strongly. So in terms of moves which are strong, I don't even need to look at a chart. I can tell you there's a lot of New Zealand buying going on right now. And if you were looking to counter that, you'd be looking at something like a euro or a Swiss franc, maybe the dollar, but the dollar's kind of flattening off a little bit. So certainly in terms of stronger moves, it will be against these two, one of these pairs here. So you're spoiled for choice at the moment. You'd be looking at maybe an Aussie or New Zealand against the franc or a euro. But that's what you're searching out the whole time. And then of course you're tracking that, you're looking for it to continue. It doesn't always continue. Ideally, what you're looking for is across the time frames. This is on 1, 5, 10, and 15, but it's whatever time frame suits you and your trading perspective. Where are we going? Let's just have a quick look at the currency heat map. This is the currency heat map. This is on NinjaTrader. As I say, it doesn't have that flexibility, so you are limited in terms of the time frames. You've got 1, 5, 10, 15, right the way out to the monthly. If I just isolate out on the dollar, you can see here cable being absolutely hammered. These are the slower term time frames in terms of bearish sentiment, very, very strong. But then, of course, equally, you know, when these get to the bottom, and remember on the currency heat map, it's two indicators in one because you've got the intraday sentiment is reflected on these cells, which match the currency matrix in terms of the data output. And then in terms of the ranking ladder here, these move much more slowly because they are weighted, and they're weighted according to the time frame. So for example, a 5 minute time frame will carry more weight than a 1 minute, and a 10 minute more than a 5 minute, and a 15 more than 10, etc., etc., etc. So a slower time frame will carry more weight. So these pairs here will not jump up and down the ladder as they do on the matrix, because the matrix is only looking at a 7-day look back or a 14-day look back, whatever you have it on. This is basically weighted according to the time frame because time carries weight. Everything in trading is about time frames and weight. And it doesn't matter what you're looking at, whether you're looking at a volume point of control, whether you're looking at volume, whether you're looking at a volatility indicator, whether you're looking at support and resistance. The slower the time frame, the greater will be the significance of that particular indicator or the presence of that particular indicator. And that's basically what it shows you here. Because we've got so much weight over here in terms of the slower time frames, that is why cable is down at the bottom here, and that's why the other two are down here as well. Now, if this is to change and cable is to start moving up along with the other dollar pairs down here, then what you're going to have to see is, forget about seeing green down here on 5 minute. What you start to see is you want to see it up here on the 4 hour. If ultimately that translates into the daily, then you will start to see some movement in terms of cable moving off the bottom, and the same here as well. So it's basically a ripple effect. What you're looking for is that rippling motion of these gradually changing from red into green in this case, and then out here further into green, and then it will start to lift off the bottom of the heat map. So the heat map is a great tool if you're a slower term trader. You know, longer terms, you're looking at the dailies out to the weeklies, then, you know, it's a great place to go and look, check out what's at the bottom, what's at the top. I like to look at the extremes all the time. Obviously, I use the TradingView heat map because I've got the option to do it. But if you are a ninja, then, you know, use the heat map. You're looking at much lower time frames, but it's a great way. Pick off the tops and bottoms because you're looking at extremes again, and in exactly the same way as you do with the CSI, you're looking to get in early. and take advantage of a trend that starts to develop early before it gets too far advanced. There we go, just back to where we were. So, it's all, yes, there are opportunities. If you're an intraday trader and you like the 15-second chart, which I do trade, it's just, and it's a great place to practice. I'm not suggesting you trade it if you're not comfortable with that time frame, but if you have it available on this platform, or you've got it somewhere else, a very fast time frame, then use it to hone those VPA skills, because it certainly will. It just makes you very sharp, very conscious of not only what's going on a candle bar basis, but also in terms of groups of candles, how they're performing, and all the rest of the indicators. There we are, we've got a volatility trigger. As I said, on 15-second makes no difference, but on a 15-minute, it sure would, because if that came up in the first couple of minutes, that's it. Get out. I don't want to sit through congestion, which is like to follow here, or worst case, a reversal. So you see it come up, bang, make a decision. If you're in a loss position, that's a different story. Then you've got to, I guess, you've got to hope a little bit that maybe it works in your favor. But if you're in a profit position, it's a very, very simple decision. 99 times out of 100, I said many, many times before, close out, take profit. Or at the very least, if you're trading multiple positions, if you've got 4 or 5 positions on, then take 3 off, leave 1 to run, or take 4 off, leave 1 to run, leave 1 in. But take the bulk of your profit off the market. You don't want to sit through this. Okay, this is only 4 candles, so it's a minute. We're on 15-second. If this was 15-minute, this is painful now. You don't want to be sat through that. And it's the emotional stress you're going to sit through, because you're not sure now. You start to doubt, was I right? Which way is it going to go? I don't know. Could be, could not, I don't know. And you suffer the emotional stress. You don't need that emotional pressure. There's enough pressure trading without putting yourself in additional pressure. So if you get one of these and you're in profit, just close out. Simple as that. You can jump back in again. What have you lost? I know this is a small chart. We've gone from 94 up to 6 or 7 pips. So what's nothing? You jump back in. Okay, on cable, you maybe a couple of pips of spread or whatever. 1 pip spread, 1.5. Okay, so you've lost a bit of spread. So what? Cost of trading's peanuts. Makes no difference. That's the power of the indicator. Yeah. Aussie dollar and pound dollar. Okay, let's go back over to Aussie dollar. I'll go on to, no, save Anna going back on hers. Let's go to currency matrix multiples. Oh, sorry, wrong one. I want the currency pairs multiples measures matrix. Oh, sorry. Could go to, I've got the futures up as well. Let's just stick with spot for a moment. So this is on cable. That's what's happening on cable. A lot of congestion. Looks as though we could be breaking higher still. Trend monitor here, fantastic indicator. What does it do for you? Well, it does one simple thing very, very well. It helps you to stay in. We saw this volatility trick come in. Okay, you might have closed out, fine. If you didn't, you sat through that. Yeah, it transitioned a little bit, comes back into blue. Yes, we've gone back into congestion here again. It's flip-flopping around. It may continue higher. We may sit in congestion here, but it's building congestion and we'll get more levels. The other nice thing about just on this chart, just to highlight another aspect of the VPOC, when you get the VPOC like this, what you'll also get, this is the accumulation distribution indicator, you get these thick lines, because what the accumulation distribution indicator does works the same on TradingView as well. It actually presents these lines thicker according to how many times they've been tested and retested. So the thicker the line, the stronger the area of resistance or support. It just gives you a complete instant visual, no nonsense picture of support and resistance. You don't have to think about it. You know that's strong resistance. You know that's a good level of support. These are minor. They've only been tested once. These have been tested several times. As soon as you break through that level, you know you've got a really strong platform. Obviously, resistance at that point becomes support. And you'll see that all the time with the volume point of control. It's just a great, great indicator. And if you use it with the accumulation distribution, it's just wonderful. The other one was the Aussie dollar, Anna mentioned. Let's have a quick look at the Aussie dollar just before we wrap up. There we go. It's still going up. And here again, you see what I was talking about just now, this very, very strong level, fantastic level of resistance, bang, 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 couldn't get through, all the way through here, bang, bang, bang. Finally, it manages to get through, and then off we go. And then you've got this great area of support in place that if it did retrace against you, you've got some really strong support there. You've also got this little cluster here, and when you get these two, this one is slightly stronger than this one and not as strong as this one, but when you get two of them clustered like this, that's really strong. You've got two levels here, and again, you can see really strong platform of support. You break away, off we go. Through this low area of volume here, it's what we expect to see. If you're on a VPOC and you've got a low volume coming up ahead of you, terrific, happy days, because you expect the price to move through there pretty quickly, and it does. So when you get up to these low volume areas, volume's falling away, that's what you expect to see. And again, you can see on the trend monitor, yeah, we had some transitional colors here, but we're still trading positive on here. And you'd have this running across multiple time frames. Everything you do in trading is about multiple time frames. Doesn't matter whether it's a CSI, whether it's a cryptocurrency strength indicator, trend monitor, charts, volatility indicators, whatever it is, you do it in multiple time frames. It's as simple as that. That was where the buying came in. Lots of volume under there, nice pivot to the downside. That's the start of it. Off we go. It's all about VPA. There we go. I'm going to have to wrap up. Sorry, running way over time. Apologies for that. Just to give you a heads up, this is the education site, quantumtradingeducation.com. I have to say, we are working flat out at the moment, Anna and myself, to get this stock trading, the complete stock trading and investing program up. It will be up during the year at some point. I can't give you a firm date, but we are working on it, I can assure you. And it will literally cover everything to do with stock trading and investing, and huge modules on bonds, because bonds are part of stock investing. They have to be if you've got a portfolio. It's a massive program. It will be ongoing. There will be live webinars that will be ongoing as well, which will only be part of the stock trading investing program. They won't be public like this one. They will be private and only those available to students. So you can register here. Just click the button there and sign up, and you'll get all the details in due course. Funded programs going really well. Lots of students on that, climbing up through off the evaluation stage into the portfolio managers levels. So that's going really well. So if you join the complete Forex trading program, and remember that whatever you've bought in the past, we will always give you a credit, whether you've bought one indicator or a few indicators. If you wanted to upgrade to the program, or you wanted to upgrade the full package before going on the program, we will always give you a credit. And once you're on the program, then you have access to the funded program, which is basically trading our money up to a level of $2 million. You start at 5, 10, or 15,000 down at the bottom here. You choose, you decide where you want to start. There's a one-off entry fee down here. That's it. And then you're trading our money. So there's no risk to you. You're not trading your money, you're trading our money. Yes, of course, there are risk of money management rules that have to be to protect our capital. But basically, you are trading our money with no risk to yourself. This is where you'll find Anna's analysis, all the books up on Amazon. You'll find them in both Kindle and in also paperback version, and all the analysis down here with the latest blog posts. And also, as Anna mentioned, all the Facebook pages as well, where you can follow her analysis too. Again, you can register here for the stock trading program, and it's also here on Quantum Trading Software, where you'll find all the indicators. As I said earlier, if you invest in a full package, you get all the indicators we develop free of charge. There's a whole raft of them coming down on NinjaTrader, and there was a whole raft of them on TradingView as well, the radar panel and everything else. Everyone got that free of charge, the cryptocurrency strength indicator, and all of these as well. And they will be ported across to all the other platforms as and when we've launched the stock trading program. Then we'll get back to moving those across. We're also going to be developing another platform. We're possibly looking at multi-charts. Maybe Think or Swim, we're not sure at the moment. So we will be looking at adding other platforms as well. Lots of bundles there. You say you can buy one indicator, a bundle of indicators, or the full package. It's entirely up to you. That's it. Thank you very much indeed for coming along today. Hope you've enjoyed it. And we will be back again. Not sure when. As I say, we are flat out on the program at the moment, but we will see you again soon. Enjoy the rest of today. And once FOMC has come and gone, then maybe it's going to be time to jump back in again, and we should see some strong moves later on tonight, certainly tomorrow. So we will be back in the markets again as well. So see you soon. Thanks again, and bye for now.